Welcome to Bloomberg Markets. I'm Vonnie Quinn. US economic data putting a jolt into markets despite a lackluster reaction to Nvidia's earnings report. Let's get a quick check on where we stand markets-wise, because what a turnaround for the books. We're actually seeing Nvidia move against the markets today. Not what we anticipated potentially. It's not often that you see that, or at least that we've been seeing that this year. So you have the S&P 500 up 0.75% on economic data that didn't really cause any concern. Nasdaq 100 up 1.1%, even though Nvidia is down 3% or so for the session. We have about 1 in 5 stocks lower in the Nasdaq 100. That'll tell you where we stand today. Of course, just 1.5 trading days left in August. Volume is lower, but we are continuing to see some buying and selling. 2-year yield at 3.88, so just a little bit of buying there in the Treasury market. And gold really reaching back to its record again. We're only about $10 away, and we're putting back that 0.7% that we took off yesterday. So what that is a reaction to, we'll have to see. Let's get to some of those midday movers. Retailers really taking it today. Bloomberg Markets correspondent Abigail Doolittle has more. Abigail.
Yeah, the retailers, it is a big focus today for earnings. If we take a look at the shares of Best Buy, up 15.3%. This is the best day going back to 2017. And they put up a great quarter. They beat adjusted earnings by more than 15%. They're talking about renewed demand from customers wanting to upgrade technology that they bought during the pandemic and a desire for new technology. So this company, of course, has had movements to the downside and the upside right now in a good movement, perhaps the idea of a turnaround. There is also a decent short interest on this stock, so some of the shorts getting out. As for the shares of Gap, I'm going to be interested to see what they are doing. So they're up 2.3%. Earlier, the stock had been halted. This is really, really interesting because they were supposed to report after the bell, but around 9:30 or 9:15, 9:30, their release was released early. The shares had been halted for a while. In any case, they put up a great quarter. They beat earnings, sales comps coming in better. You had the Gap itself doing well, Old Navy doing well, and investors liking the results, up 2.4%. This stock up a lot this year into this quarter. So in this time of high bar expectations, they met. Not so much, though, for our last retail earner, and that is Dollar General. Shares are absolutely plunging, down 29% at session lows, the worst day on record going back to 2009 since this company started trading as a publicly traded company. And of course, folks have been wanting a turnaround with this company. Clearly, it has not happened. They missed earnings and sales in a massive way. They slashed the outlook. They're talking about their core consumer not being there to support them, in part because it seems as though there may be some economic weakness, but also because of competition from the likes of Walmart. Again, Dollar General, Vonnie, take a look at this, plunging down 29%, the worst day ever.
Abigail, thank you. Yeah, and we're going to dig into that Gap earnings fiasco a little later with Adrienne Yih of Barclays. So when it comes to the consumer and the economy, earlier today, Wells Fargo's Michael Pugliese says he sees some weakness in the labor market.
The trend is very clear here in payrolls, in the unemployment rate, even in the survey data. Look at the last consumer confidence report. More consumers reporting that jobs are scarce, fewer consumers reporting that jobs are plentiful. And when I look at the totality of the data there, I think that's very reliable. Even if week to week in claims or month to month on payrolls, you get this noise from a whole bunch of factors.
And playing into markets this morning, we saw some key economic indicators, including initial jobless claims, core PCE, pending home sales, and a revision to GDP. So for more on all of this data, let's bring in Lara Rhame, FS Investments Chief US Economist. So it seems, Lara, that Nvidia isn't the only driver to this market. The economic data does still matter. What did you make of the idea that perhaps there's nothing to see here in terms of labor market weakness?
I think this has been the key theme, that as the labor market renormalizes, it is really an incremental slowdown that should not be mistaken for weakness. You know, we need to really closely watch the unemployment rate because the move higher is on everybody's radar. But it's too, I think, early to pull the alarm bell because the reality is we are looking more sustainable. Slower isn't always bad if we're moving to something that is possible to sustain over a longer period of time.
So that's what we got out of initial jobless claims, but we can't forget the market reaction to those revisions earlier this month, right? What if the same thing happens again? How concerned should we be about potential future revisions lower?
To me, when I look at the revisions, I see that the labor market really started to renormalize much earlier than we thought. When I look at the monthly payroll gains, anything above 100,000 to me is just something that is long run more sustainable. I'm not trying to sugarcoat everything because the rise in the unemployment rate is troubling. It's moved up much faster in the July data. So I think that is what is now very critical going forward. But when I look at growth, it's still a powerful forward momentum for an economy that's really firing on all cylinders. I think that's still the story. And again, knowing that today, if we really start to see an economy that's headed towards a hard landing, the Fed has the room to move quickly. But right now, there's really no need, I think, to do more than just that quarter point cut that we're expecting in September.
Yeah, the Fed chair all but told us, he really did tell us we're getting a 25 basis point cut in September as clearly as he possibly could. What would it take for that to go to 50? Because if you look at the market, we are still pricing in 4 between now and December, and there are only 3 FOMC meetings.
Yeah, we are really sniffing around between a 50 basis point cut at a meeting versus a 25. To me, it's really a question of that unemployment rate. If it moves up again significantly, the Fed kind of drew a line in the sand. They don't want to see any further weakness in the labor market data. So, if we get that, I think that's when we start talking about a 50 basis point cut. But this is where we need to differentiate between the S&P 500 and the economy. I think if the Fed ends up moving less aggressively because the economic data is good, ironically, it may be bad news for markets and it may mean higher interest rates. And yet it would be good news for, the resiliency of the broader US economy, which is 200,000 private middle market companies. It's a much bigger economy than just these 500 publicly traded companies.
But Lara, right now, economists are looking for a 4.2% unemployment rate when we get the numbers next week, right? What would that have to be for it to be concerning? Would it have to tick up, by 2 or 3 or 4 ticks?
I think if we even move up to, I think 0.2%, if we move up to 4.5, I think we start talking about a 50 basis point cut. Again, the benefit of where the Fed funds rate is today is that the Fed has room to move fast. That's a luxury they haven't had in almost 20 years. So today, it's not my base case, but the good news should be that we have good insurance against a hard landing in case we need it.
So what then do you make of the likes of Dollar General earnings and the fact that pending home sales were lower today and that there does seem to be some pockets of weakness among particularly less wealthy consumers?
There's definitely, it feels like a two-speed economy today. And we know that things like inflation hit, the lower income cohort much harder. We see credit card delinquencies, auto loan delinquencies. It's important to not paint the entire economy with just a rose-colored glasses because the reality is we are seeing, I think some pockets of weakness. The difference between a slower economy and a recession is a really important difference. I do expect a slower economy. I do expect consumption to slow down, but I think it's a more sustainable pace of growth. And it looks more like 2% this quarter, 1.75% in the fourth quarter, and is consistent with the Fed surgically cutting rates, not these wholesale large emergency half-point cuts.
We should get a little more detail this evening with the Kamala Harris interview on her economic policies and what potentially she wants to see for a presidency should she be elected. Is the market and are you starting to game out 2 different economies depending on who is elected in November?
I think it's too early for that. I am probably more focused on the inflationary impact of either candidate's policies because today, pro-growth policies, especially those that involve increased government spending, are more likely than not to be inflationary. And I think that's something that I'm really keeping my eye on for 2025.
Lara, thank you so much for joining us today. The final week in August, Lara Rhame, FS Investments Chief US Economist. Coming up, we're following up with Scott Kelley, who almost a year ago to the day warned that commercial real estate was a threat to regional banks. Has his outlook changed? We'll find out. This is Bloomberg. This is Bloomberg Markets. I'm Vonnie Quinn. Now turning to regional banks and commercial real estate risks. Prices dropping more severely in cities compared to outlying areas. We spoke to one industry leader a year ago who sounded the alarm on the risk that commercial real estate posed to regional banks. So we're bringing him back now for a follow-up. CEO and founder of Aetos Capital Real Estate, Scott Kelley, is with us, along with Bloomberg's Abigail Doolittle. So Scott, you had this call that you were very concerned about real estate and its impact on regional banks. We have seen the KBW index come right back up to where it was. It's basically at its highs for the year, one-year highs. Are you still concerned?
Yes, look, I think the issues with commercial real estate are profound. They're identifiable. They're real. They're not going away. But it goes region by region, sector by sector. Office and retail are obviously the most troubled sectors for real estate. But I think, importantly, the regulators have taken it very easy on the banks at this point in time. I mean, you don't see, we've looked at previous real estate crises. If you look back to the RTC days, the government essentially liquidated the savings and loan industry. If you look at the global financial crisis, the risk was concentrated. Lehman, Bear, AIG, it was very concentrated. So when it came in a big wave. I think now much of this real estate risk is spread across not so much the money center banks, but across a bunch of the regional and community banks. So the inevitability of default is there, but it's going to be a regulatory matter in terms of when that trigger is pulled. And I think the consensus is it's not going to be pulled till after the elections, that the regulators are going to take, in an election year, take it very easy on the banks from a discipline perspective.
So do you think that 2025 could turn into the wave of selling that everybody's been talking about? Because last year, at the beginning of the year in 2023, there were a couple of notable office buildings that did default, and everybody's waiting for this crash. We really haven't had it. It seems like everything is so logjammed. Is that because of extended pretend at those banks? And if the regulators are no longer looking the other way, could it get ugly?
Yes. And again, I think it's going to take a long time to work out. I mean, again, the RTC happened like that. The global financial crisis, everything had to happen very quickly. Because the debt here is dispersed among so many different banks, and it's not concentrated, interestingly, in the big money center banks. It's more in the regional and community banks. It's going to take a while to work out, but I think it's going to be an excellent investment opportunity for people with capital once the repricing happens.
Is it all commercial real estate, or are there particular pockets of it, and are those pockets concentrated in particular banks? So is this going to be very specific and stock-specific stories?
Yeah, I think it will be. Obviously, the troubled asset classes are office and retail. And, you have seen some very big discounts in office buildings, particularly in places like San Francisco, the greater San Francisco area, New York City. I mean, there are deep discounts just because the secular changes in those asset categories are profound. And, you can talk about New York office for a long time, but they're going to be haves and have-nots. Obviously, there are other sectors of real estate and regions which are going to be fine. I mean, not great because you've got, in essence, interest rate risk associated with those assets, but the underlying performance is good. That's why we're focused on things in the growth markets of the Southeast, as opposed to trying to buy deeply discounted, Third Avenue office buildings.
Yes.
In some of those Third Avenue office buildings, we've been told by the likes of Yigal Namdar and others that they could go as cheap as for 10 cents on the dollar or less. But I want to return to those regional banks because we of course have the Silicon Valley really put it on that blow up, put it on everyone's radar. So if next year and the years after that the regulators get their act together and actually look at what's going on and say you've got to get rid of some of this junk, it sounds like we're not going to have, just a wipeout of these banks. But could we see, say, a dozen or 2 dozen or 3 dozen go under? Could it be that bad? Because last year you were making a call where you thought that there could be a regional banking crisis.
Yeah, no, I think it's going to take a while to play out, and that's just a regulatory matter. The fundamentals of the problem have not changed, but the regulatory environment has been a lot more lax than I think a lot of us anticipated. And as long as that continues to be the case, the banks can continue to muddle along. But I think after the election, no matter who wins, that environment's going to change.
Just give us a little more detail on what exactly you think is lax about the regulatory regime right now, because we did have that big shakeout and there was those big drops, last March, 12 months and so on. And I would have thought that the regulator would have stepped in a bit further.
I would have thought that too, but no, it just if you just run the math that people that financed with the assets with the assumption that their refinancing rate was going to be 3 or 4, that rate is now 7 or 8. So the math just doesn't work, and inevitably that's going to cause this debt to have to be liquidated or not be serviced.
Does the Fed starting the rate cut cycle help at all?
50 basis points doesn't move the needle. I mean, we're talking about epic increases, not, yes, that helps, but the extend and pretend only really works in an environment of drastic rate cuts for a long period of time, and I don't think anybody sees that happening.
All right, we have to leave it there, but thank you so much for the update. We will definitely keep our eye on commercial real estate and its impact on the regionals in particular. That is CEO and founder of Aetos Capital Real Estate, Scott Kelley, and of course our own Abigail Doolittle. Coming up, on the heels of Nvidia's earnings and outlook, we're taking a closer look at its new chip in development. This is Bloomberg. This is Bloomberg Markets. I'm Bonnie Quinn. US stocks higher today, even though Nvidia is lower by more than 3%. That's not a sentence I anticipated saying. The company disappointing some sky-high expectations for earnings. CEO Jensen Huang sat down with Bloomberg's Ed Ludlow for an exclusive interview right after the earnings call. Let's have a listen.
We made a mass change to improve the yield. Functionality of Blackwell is wonderful. We're sampling Blackwell all over the world today. We show people, giving tours to people of the Blackwell systems that we have up and running. You could find pictures of Blackwell systems all over the web. We have started volume production. Volume production will ship in Q4. Q4, we will have billions of dollars of Blackwell revenues, and we will ramp from there. We will ramp from there. The demand for Blackwell far exceeds its supply, of course, in the beginning, because the demand is so great. But we're going to have lots and lots of supply, and we will be able to ramp starting in Q4. We have billions of dollars of revenues, and we'll ramp from there into Q1, into Q2, and through next year. We're going to have a great next year as well.
Jensen, what is the demand for accelerated computing beyond the hyperscalers and Meta?
Hyperscalers represent about 45% of our total data center business. We're relatively diversified today. We have hyperscalers, we have internet service providers, we have sovereign AIs, we have industries, enterprises. So it's fairly diversified. Outside of hyperscalers is the other 55%. Now, the application use across all of that all of that data center starts with accelerated computing. Accelerated computing does everything, of course, from the models, the things that we know about, which is generative AI, and that gets most of the attention. But at the core, we also do database processing, pre and post processing of data before you use it for generative AI, transcoding, scientific simulations, computer graphics, of course, image processing, of course. And so there's tons of applications that people use our accelerated computing for, and one of them is generative AI.
Let's bring in Ed Ludlow now live, who got and conducted the exclusive interview. He's in San Francisco. So Ed, Jensen seemed a little perplexed. He even really said it to you that he was perplexed with the aftermarket reaction in the stock, given how well Nvidia has been performing. And then we got some price target upgrades today. So what do you think is going on with this market digesting this news?
Yeah, I mean, it was really interesting in the moment because what happened literally was the analyst call ended and the stock continued to slide in after hours. And when I posed the first question of the interviews, Jensen, which was we just wanted to know more about Blackwell, he literally took a sip of his drink and just stopped. He just paused and would go on to say, you know, I thought I'd explained it so well on the analyst call, which is what just tripped me up in this interview. And that was kind of the case, you know. The top line is that Blackwell, its next generation AI accelerator, is to all intents and purposes on track. But the lack of granularity on like the dollar values of sales they'll make this year, who it's going to, kind of gave the street some pause. But I think we're more sanguine this morning than we were last night.
For sure. And, you know, we have to put this in perspective. There's been a massive run up, even just this year, even since the stock split alone, right? And we're only down about 3.5% today, and it is light trading volume and so on and so on. What about margins, though? Because we're still above 50%. And presumably, you know, well, I don't know. Can they keep the margin at 50 or above for the foreseeable future?
It's funny you point out margins. I mean, broadly speaking, Nvidia has had adjusted gross margins at around 75% for quite a while now. But actually, analysts asked about it. You know, this is a company in growth mode, kind of like a private company where, you know, scaling your offering before you even scale revenue is the main priority long before you think about profit. But Nvidia is just this machine. And I actually went on to ask Jensen Huang, would you ever think about being a cloud computing provider to take on the hyperscalers at their own game? And his answer was like, no, like that is a much lower margin business than what I'm already doing. I'm very good at a specific thing, which is a systems vendor, systems to train AI models and the inference side of AI. And I think he'll stick with that.
Yes, it was a very full and compelling interview. I'd urge everybody to go back and watch it. Ed Ludlow, thank you so much. Bloomberg Technology co-host. And once again, Nvidia down about 3.5% now today. But stocks are higher, mostly due to US economic numbers. We'll break those down further next. This is Bloomberg. Welcome to Bloomberg Markets. I'm Vonnie Quinn. US economic data putting a jolt into markets despite a lackluster reaction to Nvidia's earnings report. Let's get a quick check on these markets now because we are higher. It is a lower volume day, of course. Just about a few hours plus 1 day left in August trading, but we are seeing the S&P 500 up almost 1%, and the NASDAQ 100, interestingly enough, 4 out of 5 stocks there are higher. So you can see the index itself is up 1.3%. We're not seeing too much movement in yields, 388 there on the 2-year yield. And of course, gold is retaining some of its strength. We're very close to our record once again there. US economic data, as I said, driving most of today's moves in the market. Earlier today, BMO's Earl Davis talked about the trade in treasuries.
Going to be volatility everywhere, but this is why I love being an active manager. This is why it's perfect time to be in the shoes that we're in. You know, we have our expectations. You know, as I said, we do expect yields to go lower, but the market, we also expect it to go higher, but that allows us the opportunity to get long. This is the difference between passive and active, and it's the perfect time from an active manager perspective to monetize that volatility.
US Treasury yields climbed after solid economic reports prompted traders to trim their expectations for the scope of Federal Reserve easing this year. For more on this, we're joined by Bloomberg's Liz McCormick. Liz, thanks so much for joining. So we did get a little bit of a movement, but we still haven't priced out that fourth rate cut. How much room is there for yields to move between now and, the next Fed meeting?
Yeah, I think like you just highlighted, Earl Davis was saying, there's a lot of investors who may think in the longer run yields are going down, but they're saying there might be some backup. We've had a great 4-month run with yields falling. And I think the data, like you said, is key. Today, the GDP revisions, although it was the second quarter, were a little stronger than people expected, higher. And jobless claims show the labor market is definitely not falling off a cliff. So people are really focused on tomorrow's PCE inflation, Vonnie. And next week, very key is the end of the week, the next jobs report for August, the reading of job creation. So I think people to kind of decide whether, Chairman Powell basically at Jackson Hole said they're going to start the cutting in September. He couldn't kind of make it more clear. But 25 or 50, the market's still giving about a 25% chance that the first cut is supersized, 50 basis points, but mostly sees it as coming through as a quarter. But I think that jobs data is going to be crucial to kind of, let's say, decide that ahead of time for the markets.
For sure, we had Lara Rhame earlier saying that unemployment rate, if it ticked up just, a tenth or two, might be enough. But a 50 basis point cut does seem rather large at this point. Did the Fed sort of retain optionality? Could it go at one of these meetings? And which would be the most likely one if it were to?
Well, I mean, the Fed they never say never to anything. So for sure, they retained optionality. They've no way box themselves in, and they can do it. Like if they don't do it at the first meeting, if the data turns, they can do whatever they've done. And on cutting cycles, they've been aggressive. Even on the last, this recent tightening cycle, they were much more aggressive than many of us thought with those 75 basis point increases. So, and Chairman Powell made clear they don't want the labor market to really weaken more. Inflation they feel is on the track to 2%. I really think they would love to pull off the soft landing. So they're walking a tightrope here. And if labor starts to, what does he usually say, unexpectedly or overly weaken, they can do more. So totally they have optionality.
Now, Liz, we are seeing, stronger or, quote unquote, not weaker economic data, but then there are some little signals like, for example, some of the earnings reports, the Dollar General earnings report and some, data on credit card delinquencies, and even sometimes the Atlanta Fed GDP Now tracker, gives us a little cause for concern. Are you seeing pockets of weakness that could expand?
Yeah, and I think many people are pointing out just the things that you said. And I would say from my talking to investors and economists, more than not see a recession coming just for that all that separate data. And, we had the big revisions to the jobs data. So some people are kind of even downplaying certain data that's coming out, like regular non-farm payroll. They're saying next week, if it's strong, maybe it's not so strong after the revision. So I think, and when you do listen to those company earnings, and you can hear it, I'm sure, anecdotally, like I do among fellow friends and whatnot, that it's just not as strong as it was, or people being a little more cautious saying, yeah, maybe I want to buy that new thing, but I'm going to hold off. So I do think more people than not think, like someone said to me yesterday, like these soft landings, they just don't last forever usually. And that, maybe in 2025 is when we see the recession. So I think there's enough data building that people feel like the Fed, like I said, it's a tightrope and they may not be able to do it. And then if we start seeing a clear sign of recession, then I think they pick up the pace of cuts for sure.
Liz, thank you so much. That is Bloomberg's Liz McCormick there joining us. Much appreciated. Speaking of the data, we'll continue this conversation now with Bloomberg Economics' Stuart Paul, who joins us. Stuart, is there anything that Liz said that you disagree with? Is there anything else that concerns you out there?
I think that the odds of a 50 basis point cut in September are a bit higher than what Liz was suggesting. I think that we've seen enough cooling in the labor market that it's not just the August payrolls that are going to decide it. I think that might be what the market's waiting for. In fact, it looks like what the market's waiting on if we were to look in the terminal WIRP go. But I think that when we see continuing claims rise, as we did today, when we see multiple regional Fed surveys showing in August that employment and demand for labor is weakening, I think that we see sufficient cooling in the labor market that would warrant the 50 basis point cut. And I think that odds are that the Fed is going to believe the same thing come September.
Well, you know, it's interesting because we had Mary Daly on just a couple of days ago, and, you know, famously the San Francisco Fed is sort of the labor Fed, right? Or one of the labor Fed. I mean, they're all labor Feds. But she said that she had been speaking with companies, as they do at the San Francisco Fed, and that they might be looking at headcount and maybe preparing to sort of lock in the headcount, but not trimming.
So some might not be trimming, some might be just reducing the number of hours that workers are showing up to the office. That's going to slow personal income growth, and we'll get some personal income data tomorrow. In fact, we expect that the labor component, the employee compensation component, is going to show no growth in the July report that we're going to get tomorrow. In addition to cutting back on hours, if you see demand cooling, you still have folks entering the labor force and pushing the unemployment rate up, even if there aren't en masse layoffs. So you still see cooling of the labor market. You still see the balance of supply and demand for labor shifting towards a bit of an excess of supply.
Since when, though, did more than 100,000 jobs created per month and continuing claims that are not going anywhere, they're, you know, rolling nicely along on a 3-month average, since when did that constitute, you know, concerning cooling?
When we saw an influx of an immigrant population that helped to boost up the pace of hiring that would be consistent with a steady unemployment rate. I don't entirely think that it was my eyes that were deceiving me last month when the unemployment rate jumped up, and that's even again with 100,000 jobs added, but that's because 100,000 jobs added is not enough to keep a labor, to meet labor supply where it's moving and where it's going. And I think that that's going to continue to be the case. I think that we're going to continue to see supply of workers outstripping demand or exceeding demand, and we're going to continue to see upward pressure on the unemployment rate.
Well, there you have it. Exactly where you and Liz are arguing. That's exactly where the market has its difficulties parsing all of those data out. Our thanks to Bloomberg Economics' Stuart Paul for joining us there. Coming up, it's been a rowdy day for retail earnings after Best Buy smashes expectations with its latest report, while Gap catches investors off guard. More details next. This is Bloomberg. This is Bloomberg Markets. I'm Bonnie Quinn. Some analyst action off the back of more retail earnings. Foot Locker upgraded to overweight from equal weight at Barclays following its second quarter results. Analyst Adrienne Yih says the footwear and sports apparel retailer is stepping in the right direction due to positive same-store sales and an inflection in merchandise margins. Adrienne also has an overweight rating on the Gap, which surprised investors today by reporting its second quarter results this morning. Results were originally set to come out after the closing bell. Gap is up about 2+% right now, but it was halted for more than an hour and a half, and it's our stock of the hour. Joining us for more is that analyst, Andrienne Yih, Barclays Capital Managing Director and Senior Analyst covering e-commerce and brand retailing. Adrienne, I have to start with Gap because it was quite phenomenal what happened today. We got some numbers, we weren't quite sure what exactly had happened or if we could even trust them, right? And the stock halted. What happened?
I think it was just one of those kind of fat finger kind of days. We clearly, and the company had actually said on the last quarterly call to expect that press release after the market. They're always an after the market reporter. And so as we were listening to, I think it was the Burlington call, across the tape comes, Gap's numbers. Now, the good news is they were phenomenal numbers, right? The gross margins were up about 500 basis points year on year. They beat the street, meaningfully, 54 cents. I think they beat by 13 cents. And it was really driven by the Old Navy division, which is the vast majority of earnings for the company. So luckily, it was a very, very pleasant surprise.
Yeah, it was. Now, the stock was up 9% right at the open, and then it dropped precipitously, and now it's only up about 2.5%. Do you think this gaffe had anything to do with stock price moves, or is this about the reaction you would anticipate?
I think what it did is it took away a little bit of the thunder of the upside. So I think people were distracted doing other things. Clearly in the pre-market, I think you're right, the stock was up 8-9%, and then it kind of actually was down right before it got halted, right? Because everybody was like, to your point, do we trust these numbers? So I think what's happening right now is you're starting to digest what's actually going on. And the gap, right, the stock as a consolidated entity is really being driven by one division, and that is Old Navy. Gap division, which was a positive surprise last quarter, it actually missed the comp, as did Banana and as did Athleta. So I think, at the margin relative to last quarter, you're putting more weight on Old Navy to continue to do better. And probably, the Gap brand, I should say, has faded from where we thought the business was last quarter.
Yeah, now American Eagle as well, its stock is down about 3.5%. Are these individual stories about, merchandise product, how well inventory is being managed and so on? Or has the consumer got something to say about this? Is the consumer's pocketbook involved here?
The latter. So there's no question that what we've heard, those retailers that have gone before us, so whether it's Walmart or Target or TJX, Ross, and then Burlington, the ones that are creating value, right, and dipping into their pocketbooks to provide value to the consumer, they are taking market share. And it's at the expense of those retailers that are trying to hold full price selling, right? So it is very clear that since last quarter, and even as we went through May, June, July was really, really soft. And then we're starting to see a little bit of a pickup, but for back to school, but for the seasonal uptick of back to school. So people are still playing it very close to the vest, very conservatively, because they don't know if this, August month to date is going to continue. So what I would say is that you kind of have a bifurcation between those who are providing value at the kind of lower end price points, right? Creating that value, and value as we define it is price paid for quality received. But there is that silhouette shift, which continues to kind of keep us in the lane of denim retailers, Gap, driven by Old Navy. We do like, buying the weakness on an American Eagle and even on Urban Outfitters that printed last week.
Yeah, and then I have to talk to you about your call on Foot Locker, because you're already pretty positive, but now you're one of only 4 analysts that are saying buy this stock, and it hasn't reached its price target yet, even though it's up today. Your new price target is now 34, and like I say, there's only 3 other analysts with price target higher than that. Why?
So we like to look at kind of where these companies are. If you think about a sine curve, right, these are cyclicals. Right. So to the extent that if you're at the bottom of the cycle, the very, very first thing that we look for is, did you clean up your inventory? And this is the 3rd consecutive quarter where sales are actually growing faster than inventory, kind of supply demand, right? It props up kind of the pricing, the out the door pricing. You don't have to discount as much. And then I think the clincher here for us was the positive comp. Right. They put up a 2.6% comp. Street was looking for a 0.9%. It is the first positive comp in 4 consecutive quarters. That return to a positive comp creates leverage on the P&L, combined with recapture of the merchandise margin, and we just like the stock pulled back because they're going to move their headquarters, and nobody likes a headquarter move. But what we know is that the fundamentals today are sound, and we like those dislocations where people get worried about something that might happen in the future. But what we know is that the numbers are getting better.
Adrienne, thank you so much. What a busy season for you. You have Lulu and Ulta out after the close, and you're cautious on those. And then, of course, we're going to hear what happened, I guess, when we hear more from the Gap. That is Adrienne Yih there over at Barclays. Let's stay on retail, because Best Buy also reported sales of computer and tablets were strong in the second quarter as shoppers dished out money for new electronics. The company also raised its earnings guidance for the year. Joining us now for more on these retailers, Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines Analyst. So what did Best Buy get so right this quarter, Lindsay?
So I think, they did have a solid quarter and they did raise the guide on the bottom line. But I think what is really driving the positive sentiment here is that we're seeing signs of a recovery in demand and growth on the horizon. And this is after 3 years of Best Buy really battling sort of soft demand and coming off of pandemic-driven highs when everybody was buying a ton of electronics and goods for their home.
So definitely cost discipline paying off, and we do have the holiday season coming up, but it's still not trading at comparable multiples to its peers. Is there a path to that?
Yeah, so we see profitability showing a lot of strength in the first half. The comps are going to get a little harder in the second half, but Best Buy has done a really good job controlling those costs. They also have done a really good job being selective with promotions, and we do expect that to sort of continue into the holiday. As Adrienne mentioned in the segment before me, the consumer is very value focused. So thinking about holiday, Best Buy is really going to focus on those key sales events and promote items that drive store traffic and get people into the store for those events. And then they might try to be a little more selective on other items where they can maintain a good margin there.
And just briefly, Lindsay, what will be the items that Best Buy will be really stocking up on for the holidays?
I think the category that I'm most excited for when I think about the fourth quarter is TVs and entertainment. That category has been relatively challenged over the past 4 quarters or so, but there does seem to be some new products coming out there. And as we saw with the laptops and the computers in the second quarter, that newness is a real key driver. So we think if there's some newness in TVs, we might be able to, see some uplift in that category.
Lindsay, thank you so much for joining. That is Lindsay Dutch there of Bloomberg Intelligence. And I just want to mention the S&P has just hit its session high, up almost 1%. It's just backing off that very slightly now. Well, coming up, private equity's latest play might surprise you. We'll have the details next. This is Bloomberg. This is Bloomberg Markets. I'm Bonnie Quinn. A story outside of today's market moves that getting some attention is a new article from Bloomberg Business Week. It involves private equity, don't you know, making a play for another demographic in sports, youth sports. For more on this, we're joined by Bloomberg's Ira Boudway, who wrote the article. It's a fascinating article. Ira, take us through some of the geographic locations and what we're actually talking about here, the private equity, and specifically a couple of people within private equity are getting into.
Yeah, the main players that I wrote about for this story are David Blitzer and Josh Harris, who have started a company called Unrivaled. Now, of course, they're well known in the private equity world. They also own multiple professional sports franchises, the Commanders, the 76ers, the Devils. It's a long list. And they more recently have started getting into youth sports. So the company that I focus on that their portfolio began with is called Cooperstown All-Star Village. And it's an annual baseball tournament outside of Cooperstown where week after week, all summer long, basically 12-year-olds come up and play baseball. And it's $12.95 a head, basically.
Yeah, and we're not talking $12.95.
No.
We're talking almost $1,300.
Yeah, per player. And I became aware of it because my son, I have a 12-year-old son, plays youth sports, and he was doing the other rival Cooperstown tournament just down the road. And I had seen what Harris and Blitzer were doing, and I became really curious about it because it's they say roughly a $50 billion industry right now.
Right, exactly, right. And growing presumably because it's a fairly immature market, pun intended. Now, they are making improvements. It's not like that you're just buying this up in order to sort of carve out revenue from it. What are they doing for these young players in these camps?
Basically, they're injecting money and headcount and talent is their plan, and they just are trying to expand the operations that they've bought. So they're, in many cases, they're keeping the name and they're keeping a lot of the staff. And in the case of Cooperstown All-Star Village, they bought an additional 66 acres to the 70 they already have, and they're essentially going to double the thing, as they go. And they think there's a lot of unmet demand for youth sports, and that they can just broaden the base of participation.
And it's not just putting little heads, onto the fields or the baseball, whatever they're called, diamonds, I guess.
Yeah, diamonds.
It's also about the parents, because of course you have to. We're talking about Cooperstown, and 20 miles south, it's Oneonta, New York. It's
right.
Not. So what are they doing for the parents to give them a better experience? And the other sort of concern here is, does it really make it impossible for the less wealthy parents to participate?
Yeah, so youth sports have had sort of a growing problem over the last couple of decades where it's become less about play and all the social and emotional development that we associate with it, and more about sort of competing to make it to the next level, where you're trying to get a college scholarship, and it's become very professionalized, very expensive. And so that's the fear for what private equity and what these investors might do, is just keep pushing it in that direction. What Unrivaled says is, no, this is really about access and improving the experience for parents. So they are doing things like, adding restaurant space and improving the uniforms and improving all of the little things that parents know well, where the scheduling apps and the payment systems are kind of really not that well coordinated and reliable when you're dealing with the small mom and pops that have typically run the youth sports industry. So they're just trying to sort of professionalize it, raise the standards, and expand it. And I think along the way, sell parents lots of little add-ons, you know, whether that's beers while they're watching their kids play,
Yes.
or photos of their kids playing, or what have you.
The experience economy getting more buy-in from private equity, and I would recommend everybody read this story from Ira Boudway. Do want to bring you some breaking news real fast. The United States has been affirmed at AA+ by Fitch with a stable outlook. That's just coming out in the last few moments. That about does it for Bloomberg Markets. Do stay tuned for a full afternoon of market coverage, the second to last one in August. Here's a picture of how markets look right now. This is Bloomberg.